Hey guys, welcome back to another amazing episode of Real Estate Coach Uncensored. My name is Greg McDaniel.
And I'm Bernice Ross. We have a great show for you today. It's called When Skyrocketing Prices Can Cause You to Lose Your Home. A few days ago, I was talking to one of my friends, and he was asking me about doing a 1031 exchange, different kinds of options on one of his houses that he has. It's a rental house. And he says, I need to sell this property before my property taxes outrun my cash flow. Now, if you're in a state like California where your taxes can only go up 2% a year, that's not such a big deal. But here in Texas, they can go up 10% of last year's tax bill each year. And consumers all across the country, we're happy, homeowners are happy about the increases in our valuations, but we've got higher food prices, higher fuel costs, inflation. All of these translate into less ability to pay your property taxes. And to give you an idea about how bad it would have been if I stayed in my house that we sold in 2015, our tax bill the year we moved in 2015 was $18,000. And today it would be $26,354. And by 2025, that would be the full increase in terms of the property value. If they didn't go up anymore, it would be $38,585. That is doubling in a 10-year period because of how crazy the prices are here. So now we've got this going on. The vultures are already lurking, Greg. I got this email a couple of days ago, and this is what it says. When the moratorium expires, it will create a flood of foreclosures. And they're talking about the moratorium on the lenders not being able to file on notices of default on certain kinds of loans. So when the moratorium expires, it will create a flood of foreclosures and bank-owned houses, the likes of which we've never seen. With 3.7 million Americans not making their house payments, there's a flood of foreclosed homes set to hit the market. This is your chance to collect solid payouts from snapping up these houses and selling them for a nice profit. In other words, selling them for the property taxes. Now, this makes me nuts when I see this, because this is someone who's a vulture, who's selling webinars and who's showing people how to invest. And yes, it's an investment strategy. But my job as a realtor and someone who loves my community, I want to help people stay in their homes if we can. The other problem is, Greg, according to the New York Federal Reserve, there are about 2.2 million homeowners who are still in forbearance and have not, and 70% of these have not been making any payments since they entered forbearance at the beginning of 2020 in many cases. So this means that the serious delinquency rate, which is defined as 90 days past due, can shoot up from about 0.9%, 0.09%, less just under 1%, to as much as 3.8%. That's 4 times as much. What we're looking at right now, there could be a flood of foreclosures coming on to the market. So what Greg and I want to talk to you about today is how to outsmart the vultures and help people stay in their homes. And Greg, you had a great story about what happened with some clients where you bent over backwards to help them stay in their home. What happened?
Yeah, what we did is they've been clients of ours for 16 years, and we sat down and we talked about their finances. And I said, Mr. and Mrs. Homeowner, do you guys want to stay in this house? They said yes. I said, do you financially think you can? They said, we don't know. I said, I'm going to do 2 things for you. I'm going to put you in contact with 3 different lenders. We're going to see if we can keep you in this property, restructure your finances, and we'll figure out where we go from there. If we can't do that, then what we're going to do is we're going to get you pre-approved and we're going to get you into another property. And they said, why would you want to do that? You're going to miss out on a commission. And I said, yeah, 100% I will. But the number one thing is to keep you and your 3 boys, here in the house. Ultimately, what took place is that their kiddos are extremely good athletes and they're training for the Olympics. So there's a lot of money going out for training. So they just financially just wasn't going to happen. So what we did is we put up $10,000 of our own money. We put it on a lien on the property, had the attorneys draft it up. And then we fixed up the property with 10 grand. and they get another $200,000+ on the sale of their property, then we can help them buy another home. And they said, thank you so much for this. You know what, by the way, could you help us sell our investment property and help us buy another property? And I said, why, yes, I can. Thank you for asking.
So this is a great example of how helping someone, and even if they don't buy something from you or if you can't work it out, chances are you'll get the listing on their house if you've tried and couldn't and it didn't work out. And if you do keep them in their home, you're going to get tremendous press because they're going to tell their friends and everyone they know about how you help them out. So this is huge. So Greg, what steps have you seen homeowners take to be able to stay in their homes?
There's three that really come to mind, Bernice. There's three that really kind of jump to the top of my mind really fast. The first one would be combining households and or renting out part of your house. Now, if you're able to rent out a room or two rooms for $500 to $1,000 a month, that money will really make a big difference in either paying down debt or in regards to paying back taxes or in anything else you want to do. With the pandemic and everything else, people are looking for creative ways to do it. So, you know, if mom and dad live in one house and they're having a hard time, have them sell that house, bring them over into your home. Now you guys eliminate a lot of debt there. And one more thing when it comes to combining households or, you know, renting out part of your house, if you have adult children who have boomerang back to your home, if they're not paying rent, out they go.
Or make them pay rent.
Make them pay rent.
You don't want to lose your house because your kids are leeching off of you.
No, you do not. You know, the second one that I really want to talk about is being ruthless. I mean, when it comes to cutting your unnecessary bills, there's a phenomenal app called Truebill that I use, and it's absolutely incredible. You can go in there and you can sign up for them. And what they'll do is they'll go in and look at all of your reoccurring billing cycles that take place. And you can eliminate that without even knowing it. Also, if you have two cars, go down to one car. I mean, I did that myself. I had three cars and I went down to one car. I'll tell you one thing, greatest thing I've ever did in my entire life, but start taking possession and ownership of what your bills look like, and then just cutting the unnecessary stuff. If you don't watch Netflix, cut Netflix. If you don't watch Hulu, cut Hulu. You know, there's a lot of these things you guys can get rid of.
No, Greg, those are all great suggestions. And again, if you need to come up with $2,000 or $3,000 more a year, this is how to do it. It's simple and it's virtually painless.
So Bernice, let's move on to number 3. This is obtain a home equity loan. Now, walk me through this and why this would be a value add for any of our viewers and readers.
So Greg, this option of taking a home equity loan means that you're going to pay more in the long run, but it can be a good short-term solution for 5 years or a little bit longer to pay less out of your pocket and give you a little bit more flexibility with other expenses. So if my property taxes, say I live here in Austin, they go up $2,000 a year, and they're going to go up a total of $10,000, but so they'll go up $2,000 the first year, and then it'll be $4,000, $6,000, $8,000, $10,000. So when I add those numbers together, it totals $30,000. Now I went to an amortization table for that loan at for a $30,000 loan at 4.5% at $229.50 per month. Instead of paying $30,000 those first 5 years, I will have only paid $13,770. In other words, I will pay $16,230 less. So that gives me some flexibility in being able to stay in my home. You need to note here that the first 2 years that you have this mortgage, you will pay more out, but you'll get the savings in years 4 and 5 if you stay in the home. So that to me is not the best possible outcome, but it is one way. Okay, Greg. Now, it's really important. There's a big difference between a home equity loan, which is something we're all familiar with. You can also get a home equity line of credit. And we looked at one of these for what we were doing when we were going to, do some refinancing of some things for us when we were looking at home equity loan. The home equity line of credit at first glance sounded like a good thing because you just pay for the amount that you just pay interest on the amount that you take out. But here's the problem. The rate is a variable rate. So it moves around with its tied to one of the big indexes. But when I looked at Bank of America's disclosures on this, you know what the cap was on these loans? Interest rate cap, 24%. So this is not a good idea. So Greg, there's another great option here called a home equity conversion mortgage. The abbreviation is HECM. These are commonly known as reverse mortgages, and they're available to people who are age 62 or older. Now, the way they work, it's kind of cool. It's a little bit confusing, but the only one that is government insured is through FHA. And I would suggest that if anybody's going to do this, that they go with an FHA approved lender, because then you get the federal insurance. So let's assume that I paid off my home. It's worth $500,000 right now. I'm sitting on that equity, but I don't want to sell it. Well, what I could do is I could take a reverse mortgage up to about $250,000 to handle bills and other expenses. And then I don't have to make any payments back. It's a negative amortization. And here's what Mike Banner, who's with a group called HECM Advisors, told me when I interviewed him. A reverse mortgage is a special type of home loan that lets you convert a portion of the equity in your home into cash. It's the equity that you built up over years of making mortgage payments that can be paid to you. But unlike a traditional home equity loan that we just talked about, or a second mortgage, borrowers do not have to repay the HECM loan until they no longer live in the home or they die, and then it goes to their heirs. But you can use these to purchase also. So say that I want to buy a $500,000 house, I could have $250,000 of that in a reverse mortgage. Then I could put down the other $250,000. Well, what would happen is that $250,000, would start, the negative amortization would start to eat it up, but I would have no payments. Now, this is a great godsend for people who are 62 years of age and who have limited incomes, who have a lot of equity locked up in their homes, and they do not want to give it up. Now, there was one point in time where the interest on the reverse mortgage could exceed the property value, and you had to pay that, or your estate had to pay that. But FHA made a change, and here's what the current rule is. When the borrower dies, the loan becomes due and payable. The heirs will have to pay the full balance. This is if it's over the amount that the property is worth, or 95% of the loan amount, whichever is less. So Greg, there's a fifth option. It's something I'm really excited about. It's called a shared appreciation mortgage. And the way this works is, say I own my home and it's, and it's free and clear, or I have a low loan amount on it. And my husband passes away. I lose his Social Security income, and I'm struggling now to make, to stay up, keep my head above water and make payments and everything. The way these work is that you can sell part of your equity in your house to an investor. And the way it works is that it's not a loan, so your payments don't change, but you get the cash. So for an example, on a $300,000 home, the investor might advance the owner 10%, that'd be $30,000, in exchange for 20 to 25% of the future equity. And what's fascinating about this model, if the property values go up, then the investor wins. If the property values go down, they suffer right along with the homeowner. Now, there's a great discussion of this in Investopedia. We've got this linked up in the article. What they do is they go through these in detail, and there are 4 companies that are out there doing this right now that they actually recommend. Those 4 companies are HomeTap, Noah, Point, and Unison. Again, that's HomeTap, Noah, Point, and Unison. And this can be, and some of these investors will go, they may go up to 50% of the value, even to get 75 or 80% of the future appreciation. Please note, it doesn't impact anything that the homeowner has right now. And they're advancing the money based upon how much they believe the house will appreciate over a long period of time. Now, and the way this works, it is not tied to an individual property. It works the way that insurance does with an actuarial table, where they're looking at average increases spread across a whole number of properties. And that's how they make these things work. So you will know exactly how much they will be how much you're getting. And then there will be a given percentage that you will share. Okay, Greg, so I want to turn this back over to you, because this is one of the things you're really good at. How can the people who are listening to this find these struggling homeowners so A, they can help them, or worst case scenario, if they have to list their property because they're facing foreclosure and they can't figure out a way out of it? So Greg, you're really good at, identifying different types of people to market to. If you were trying to reach someone who is a struggling homeowner, what would you do personally based upon the tools that you use?
It really would depend on the homeowner, really. I mean, we have print, digital, social media, YouTube. I mean, we have a bunch of different ways to reach out to them. But I would kind of figure out who my audience is. And then I would go and identify the people that are in distress or have an issue that you can help them solve. You can go to your public records and visit them and get that information there. You can go to foreclosure.com and get the information there. You can even go to like a company called likely.ai and get a targeted list of homeowners. They might be still be in forbearance or be delinquent. Also, last resource that I really love, not last, but just the last one on my brain right now, is reisource.com. And you can literally get names for about 10 cents. So it's incredibly affordable.
Yeah, I love REI Source because you can have them search for people who are in forbearance, people who are in foreclosure. So instead of trying to figure all this stuff out on your own, that, in many cases, it may be less than 10 cents per name. So it's a great resource for doing this. Now, your messaging is going to ask this simple question. Are you or someone you know facing foreclosure or being forced to sell due to higher taxes? Do you still want to stay in your home? Now, if they answer yes, here are 3 calls to actions that you can use depending on how you choose to market. So if you want them to contact you on the phone, then you would use this call to action. Contact me at 800-555-1212 to discover what you can do to keep your home. Or if you were going to use this on your website, or if you send out, order a special report, click here to receive our special report that explains 5 different options to help struggling homeowners keep their home. Or you could say, click here and you could do a video, 5 ways distressed sellers can keep their home. Again, you adjust your marketing to fit how you want them to get back to you. But the thing that you want to do before you share that video or that special report, make sure that they register for it with either, sending you a text message so you've got their phone number, or alternatively, that they sign up and give you a valid email. So Greg, what's your final takeaway for today?
What I would say, I would do everything you can do for your clients to keep them in their homes. And if you can't, then you help them get that either sale or referrals. But your number one concern is going to be your clients, hands down, no ifs, ands, or buts about it.
And Greg, you shared earlier in the show about, when you did that for a family and how much more business that brought you. So again, this is being in the business long term, and it pays off. Thanks for being with us today. See you next time.